I'm going to shift gears and look at housing for a few minutes. Are we looking at a bubble, or is it just a tiny little balloon? On the left of the screen here is a newsletter that one of our senior financial advisors, Dylan Reese, wrote on Vancouver housing last November. And on the right is the International Housing Affordability Survey. And one of the key takeaways from both of these is that based on median household income, Vancouver is the second most unaffordable major city in the world. So, are we doomed? Well, yes, according to Maclean's. This is Maclean's from January. And what's their headline? I think it says, "Housing bubble has burst and few Canadians will emerge unscathed." So in their view, it's a big bubble. Here's some of the statistics. Rob pointed out earlier, if you look at the far right, that's the average of the Greater Vancouver pricing on real estate year over year. So that from January 2012 to January 2013, there's been close to a 3% decline. Moreover, a minus 8% return from its peak in May. Rob's slide was, I think, roughly minus 5. It depends on your source, but somewhere between minus 5 and minus 8. So housing in Vancouver has already come off a fair bit. This, to me, though, is the real key takeaway and the most important slide for me. This comes right from the Greater Vancouver Real Estate Board website, and they have statistics going all the way back to 1976, so this is 35 plus years. And you can see the top line that we're using is detached housing in Greater Vancouver, and the annualized rate of return has been 7.4% per year for 35 plus years. Interesting to note, that's pretty much the same as the Canadian stock market. So that's what it's done for 35 plus years. Here's what it's done for the last 10 years, 10.1% per year. So that's a 3% annualized rate of return above its historical average. And I'm a big believer in the strength and the power of mean reversion. And it's going to occur. And it can occur in two ways. The first is, and as Rob pointed out, it's actually most likely our view, markets or the price of real estate will trade sideways for 4 years, and that'll bring it back to its average. Or you can have a 1-year price drop of 20%, and that'll also bring it back to its average. But it's one of the two. All right, so I was being very glasses half empty. I'll go with the glasses half full. I think all of us have seen the headlines. We all know, and if you were here early enough to be at the reception and you looked out the window, Vancouver is constantly pointed out as being one of the most livable cities in the world. Depending on the list you look at, top 2, top 5, but we live in a great place. Here's also what some of the data shows. If you are in the glasses half empty camp, you're going to point to the debt-to-income ratio. You can see in 1990 it was 91%. So that means for the average Canadian, the amount of debt that you had relative to your annual income was 90%. Fast forward 20 years later, we're at 164% on the debt-to-income ratio. So that's the glasses half empty. However, that's not all of it. When you look at debt to assets, there actually hasn't been too much of a change. Debt to assets is up slightly. Net worth, on the other hand, on an inflation-adjusted basis, we're far better off today than we were in 1990. There's been a significant increase in the average net worth of Canadians. And lastly, on owner's equity, it hasn't changed. Roughly 67% is the average amount of equity that Canadians have in their home. Let's look at the US. This is from 2011. In 2011, the average US homeowner ended the year with 40% equity in their homes. Even if there's a crash in housing in Canada, with a 20% drop in the price of real estate, that will only bring the owner's equity down to 60% here in Canada. So we really don't think housing is going to be that significant a factor in terms of a drop. All right. So when you weigh them in balance, glasses half empty, half full, if you're in the empty camp, you're going to say the 10-year price average has been much above the long-term historical average. Interest rates are at a historical 50-year low. There's only one place for them to go, and that's up, so that'll be a headwind. And there's modest economic growth in Canada. The aging boomers will be downsizing their homes. And lastly, the price-to-rent levels in Vancouver are amongst the highest in the world. If you're on the glasses half full side, You might say that while the 10-year average is above its historical norm, in the last 5 years it actually hasn't been that significant. You're going to say, yes, while interest rates may only have one way to go, we don't see them going up anytime soon. Vancouver is a great livable city. There will continue to be Asian immigration into our city. And lastly, Canada, and more specifically BC, is a great tax regime, and I'll touch on that in a few moments. But all told, relative to the lifestyle you live here in this country and in this province, relative to the taxes that we pay, it's a great place to be. So, our conclusion, be prepared for flat prices over a few years with perhaps a moderate risk of a quick short-term adjustment in prices. For those of you that are investors in our hard asset real estate limited partnerships, here's the summary for 2012 on our Canadian pool. We ended the year with total market value on the real estate assets that are owned in Spire Canada of $350 million. We have total client equity of $183 million, which is a fairly conservative 50% loan-to-value ratio. Last year, we took in $37 million of new capital. In 2012, you earned a return of 8.1%, which we think was a great result. And since 2005, that's been close to 9.8% per year. And lastly, in Canada, our focus continues to be on industrial, retail, and commercial properties. No multifamily residential real estate assets in our Canadian pool. On the U.S. side, our market value ended the year at $192 million in assets. Total equity is $66.1 million. We took in $31 million of new capital last year. The 2012 return, very similar to our Canadian pool at 8%, and since 2010 that's been 8.6%. We've now acquired and are up to a total of 8,000 individual multifamily, individual units across the multifamily residential real estate that we own in the United States. We're very excited about U.S. real estate. We think this will continue to be a good opportunity for us going forward. And we've had a lot of, as Jason mentioned, we acquired some assets in San Francisco, which was a great addition, as well as some recent assets that we've acquired in Seattle. In terms of commercial properties, our focus for the U.S. pool will continue to be in the Pacific Northwest versus the multifamily. We have a focus in the southeastern United States. Some changes to both of some changes to our real estate pools. Spire US, we increased the distribution on that from 5% to 6%. We've moved now, given the size of our pools and the economics behind them in terms of sizing, we've moved to quarterly net asset valuation from annual net asset valuation. We now have weekly opening opportunities in both pools. And Nicola Crosby just recently launched a new website. Feel free to take a look. There's information on all the properties that we own on the new website. So there's lots of drill down detail there. Lastly, I thought I'd end with our most recent acquisition. This is Spire Canada. This is the Lougheed Supercentre in Coquitlam, and we just closed on this less than a week ago. Here are the highlights. March 28th was closing date. $29 million was the purchase price. It's fully occupied with a tenant roster that includes such great businesses as Cactus Club Cafe, HomeSense, Reitmans, and Canadian Western Bank. What we really like, of course, within a 20-minute driving distance of the Lougheed Supercentre, 500,000 people live. And we acquired this based on pricing and our forward-looking net operating income at somewhere between a 6.2 and 6.3% cap rate. These are the types of quality hard asset real estate investments that we're looking to have our clients hold in their portfolios for the long term.